Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to look at the market conditions and ratios. I'll show you that a commodity bull market's coming. It's probably going to be a big one. We'll take a look at the commodities and all the ratios to show you which commodity that is, which sector I would be overweight in, and which ones look the best based off of how the ratios are forming against each other. This is really how I determine what sector to go into and overweight. And there is a sector that looks really good, really good. And I think it's going to come in overweight here very soon. Or I should say, it's going to outperform everything. And I'll let you know which one that is. We can see it in the charts. So let's dive in here. I'll give you my financial opinion. Please don't use it as advice. And here we go. So we've got the dollar here, the dollar. Usually when I see in expansionary phases, the dollar goes down, but we've been going up. And we could be breaking to the upside here if we break through this resistance area going across and this resistance coming up. So the trend line coming up and the trend line going across. Or we could hit our head and then revert back lower. We've got a little bit of a wick at the top. Remember, this is a daily candlestick where we could bounce back and come on back. Which way is this going to go? I don't know if it really matters because we have commodities outperforming everything. This is just telling us the relative value of the dollar. Usually when the dollar's when the dollar's stronger against other currencies, usually people prefer to invest in dollar-denominated assets. But when the dollar gets weaker, then that money rotates out. And I think the money rotating out of the investment, dollar-denominated assets, has an impact on this currency too, because it's money flowing away. And I think we're going to see money flow out of the stock market and bond market, which could have an impact on the dollar. Again, things are very complex when it comes to the DXY, but that's kind of just my viewpoint on it at this time. The 10-year yield continues to move higher. This is the driver of the rotation of money. Money in bonds and stocks does not like higher interest rates, especially those that are highly growth dependent. High growth stocks have net present value calculations, and this interest rate is used for that. When the interest rate goes up, the current valuation or the current value goes down with higher interest rates. So the PE ratio is leveraged to the interest rate. And if you have a declining interest rate, the PE ratio levers up. If it has an increasing interest rate environment, that PE ratio deleverages, goes down. So that is the 10-year yield, and it's going up at a pretty big pace. I think it's going to cause some money to rotate into commodities, and we'll be able to see that. So I'm just going to start with this. I'm going to go down the ratios that I do have. The XAU to gold ratio is looking very favorable for gold and silver miners with an outperformance over gold. That is this guy here. We are coming on up. It looks like to me that the gold and silver mining companies are going to outperform here. So, it might be a good idea to look at gold and silver mining companies at this time. Now, I'll look at some other ratios and show you some other things that might also look very good. So, scrolling on down here to my other ratios. Let me get down there real quick. Almost there. Here we go. So the CRB index to the S&P 500. This looks good for the commodity complex index to outperform the S&P 500. So stocks outperformed during this period. Stocks outperformed here. Now the commodities are going to outperform going on up. Looking at a daily candlestick, look at the ratio. The CRB had a nice big move here. We're in a little consolidation period. And then I think we're going to move higher. It looks like it's already starting to move higher. We can kind of get that right there, kind of broke out of that. And then, we've got kind of a downward sloping. And this might be a falling wedge. It might not. Maybe we go and move on higher right where it's at. But there's a lot of runway for commodities to appreciate against stocks. And we could go all the way back to the previous high or even beat that previous high. We have a lot of shortages, I should say deficits, not shortages, deficits projected in the future of a couple years out in a whole slew of different commodities. Zinc, aluminum, copper, there's a whole bunch that have deficits. Graphite is out there a little ways. We've got uranium deficits today, palladium, uh, oil, natural gas. There's deficits in like everything, absolutely everything. So I think this commodity index will do incredible things coming up in the future here, and I think we're just getting started. This is just the beginning of a move. Looking at the platinum to, we can get it to pop up here because I can see platinum to gold ratio. I do think platinum's going to outperform gold. We've had this declining wedge. We've broken to the upside, and sometimes it does this kind of long, elongated retest move. And that's what we're doing. We're doing that retest move. And it's still very cheap and favorable for platinum. So platinum's been declining. And how much longer will it decline? I don't know, but I do like it down here. It's a very cheap ratio for platinum. So platinum looks very good. Platinum to palladium. Palladium is still outperforming platinum. You can see it's a vast outperformance from a big long-term perspective of a ratio of 5.5 all the way down to 0.44, or 0.40 is where it's at right now. That is a huge outperformance of palladium. Remember, platinum is a substitute for palladium. And it's not easy to substitute. It takes time. But I don't know anyone who would engineer palladium into their products when palladium's this much more expensive than platinum. And platinum's the superior metal for being in catalytic converters and for scratch resistance and all other stuff. It's the superior metal. Platinum to silver ratio. Let me zoom out here. You could also say that this is a declining wedge pattern, and that this pattern is about to break to the upside at some point in the near future. This is signaling that platinum is cheap to silver, very cheap to silver. Platinum is the cheapest metal of all of these metals, and this is a declining wedge that's about to break at some point to the upside. We've got the gold to silver ratio. It's still hanging on favorable for gold at this time. And usually in a bull market of commodities, silver will outperform gold. So I still think there's a little bit of maybe fear in the market, and that this commodity bull market hasn't even gotten to the late stages. Because usually when it gets to the later stages, silver vastly outperforms gold. Looking at palladium to silver, palladium did some pretty good outperformance here, but I think that silver will outperform palladium in what's coming in this next bull market. We're just not there yet. Looking at the Dow Jones Industrial Average to gold, this thing is rolling over. We're putting in a bearish pattern. This is a bearish engulfing right there, that last trading day. I do think this is going to head lower, and we're going to see a compression of the ratio favorable for gold. If you take kind of a big picture view, it's kind of this rolling over that I'm seeing here. And then we're going to come back down here. Easily probably retest the 5 or 6 area, and maybe even break down here. We'll see. I don't exactly know, but it sure looks good for a ratio to compress for the favorability of gold. But this is the big long-term chart there. Going to the gold to oil ratio. The gold to oil ratio is sitting right at the bottom of its channel. We've had a massive compression all the way from 100 and something down to below 20. 15 is the average. 15, so 1 ounce gold to 15 barrels of oil is the average ratio. If we look down in here, we touched it briefly, the average of about 16 there, but almost to the average. We're coming back up. We're doing a little bit of a retest move here. I don't think this is going back up, guys. I think we're going to compress down. So I do think that oil is going to compress further against gold, and oil's the better investment at this time in relationship to gold. This is the copper to gold ratio. Usually, if you have problems in the market, this ratio dives. So if you have problems, it dives down. That's a problem there. We had a big dive in the ratio starting in 19. We dove down here all the way to the bottom of April of 2020. When you see this thing diving down like that, that usually indicates a problem in the markets. We are holding strong and steady going sideways at this moment, where copper and gold have been basically ping-ponging back and forth. So everything looks okay, looks stable. Now looking at uranium, this is the uranium to silver ratio. I'm going to take big picture views. Uranium looks like it's going to dominate here. Uranium's going to outperform silver. It looks like it's breaking out to the upside. Uranium looks like it's breaking out to the S&P 500. So you got the momentum coming down, the momentum sideways, and now the momentum's going to go back up. But that one looks really good for an outperformance. This is a bottoming pattern. Uranium's going to outperform gold, and it is starting to outperform gold. We could see a vast outperformance of uranium here in the short term. And then we've got the uranium to crude price. We could see uranium outperform crude here if we can break this downtrend line here. What this is saying is uranium's probably going to outperform every asset that there is in the short term here. At least that's what it's suggesting. And then we're also breaking the copper, uranium to copper ratio. It's breaking to the upside. So uranium's going to outperform probably everything. Uranium should be the asset we're looking at based off of the ratios. It is saying that it's starting to outperform absolutely everything. And we're probably going to see a large outperformance of uranium in the short term. Now, scrolling down to some other things here, we're going to look at like some of the commodities. This is lumber. Lumber's been in this channel moving sideways, and it's been elevated. We're in an expansion phase of real estate. We're building more new homes. This will probably remain elevated. Does it have to go rocketing higher? No, it doesn't. It just has to remain elevated at a higher level than it did before. And that's what it's doing. It's at a higher elevated level than what we've had in history before, from inflationary pressures and also probably from the supply-demand imbalance that we have in this area. Nickel is also basing out. It looks like we are putting in some sort of pattern here where we're about to break this to the upside. It's kind of tightening up for another move higher. Why do I think it's going higher? Because nickel has very little inventory and it's running supply deficits. And those deficits grow into the future. So I think nickel is another excellent opportunity for investment in the future because uranium's outperforming everything. We've got palladium here. Palladium priced in dollars. This does look like it wants to go lower, not higher, lower. But it's still hanging on. It's still been strong. We still have deficits in palladium, but I think platinum will be the one that shines in the future. Now here's cocoa futures. I'm looking at some of the agriculture. It's still kind of just grinding on this uptrend line until we hit this, I think, resistance line up top. And then when we blow through that, we're going high, a lot higher. Wheat futures already gone higher. There we are. We're still continuing to go higher. Looks like we have a consolidation pattern here, and then it looks like we're ready to move on up again. So we had one move. This could be the first wave. Then we're going to have a big old third wave coming next, is my guess. Soybean futures is remaining very elevated on its basically almost all-time highs. You zoom in on it, and it's got a nice, good move off this retest bounce. So soybeans is looking excellent. Corn futures is still remained very high. It's resting on top of its pattern, and it's about to move to the upside here to make all-time highs. So that also looks very strong. Now looking at the housing starts, again, we are remaining elevated, 1.77 million housing starts, very strong expansionary phase. I think this is a participant to the driver of the market conditions. It looks really good. I'm just waiting for new data to be released. And this is the downtrend line. And I know they changed the calculation midway. We're probably broken this downtrend line. What does that mean? It means that we're going into a paradigm of much higher inflation if this breaks and runs. Maybe even something that has inflationary problems. So we've had a very long 1920 all the way to 2020, 2021, 2022. We've broken out of this. If you use the inflation measurements that they did back here, and this is going to run. We're going to have high inflation, is what I've got. And then I think that's about it. We can go over the Baltic Dry Index real quick. BDI. The Baltic Dry Index is a index for shipping. They're shipping dry bulk. And we've got this long resistance line. We've broken that to the upside. And we're coming back down. We're gonna come back and do another retest. We're gonna bounce on this. And that's going to provide an opportunity, I think, to be a buyer. So you can come in, we're coming back down. This is on the weekly candlesticks. And I think that it's going to be a buying opportunity here at some point. BDI this is the BDI to uranium ratio. This ratio is coming down to a very cheap level, which is probably going to afford us a buying opportunity down here, which means that the BDI could still go down a little bit, or uranium starts to really outperform. This lags it for a little while, hits the bottom, and then turns around. Last bull market, the Baltic Dry Index outperformed uranium during its bull market move. You can see one wave, third, and then the fifth, and then the collapse. So this is also one, I think, to look at and look for potential investments. I've got a couple of my favorite shipping companies that I have some exposure to, and they're shown on the Finding Value Finance website. That's in the description link below. And if that's something that they're interested in, you can find out the shipping companies that I really like, and this could be one of the largest outperformers in this next bull market based off of the potential power it has and where the ratio is in relationship to uranium, which uranium looks like it's low and going to outperform absolutely everything else. So if it does, and this outperforms that, I mean, you've got the best performer, which is the Baltic Dry Index, as weird as that is. But that's what I've got for today, guys. That's what I see in the ratios. Everything looks favorable for commodities. That's where I would be, and everything looks favorable for uranium to outperform here in the short term. So that would be my preferable commodity to overweight, would be uranium. And hopefully that's how it plays out, because that's sure what it looks like in the ratios. Uranium is low, and it's progressing forward against almost everything. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. Subscribe to the website, Platinum membership, if you want to. That is what I would choose if I were someone who didn't know as much about investing. I've been at this for 18 years plus. I really do like this stuff, and I'm looking at it from an engineering perspective and a math perspective. That's all this is. And basically it comes into ratios and finding the best value when doing all these different ratios. And right now, the best value is uranium in terms of performance to value type. We'll call that a ratio. And then the Baltic Dry Index is very cheap, and I think that would be one to start looking at and accumulating some shares in. All right, guys. Thanks for listening. This is Finding Value.